Welcome to our panel today. We're very excited to talk about a range of issues on innovation in banking services. I'm Yana Miles, General Counsel and SVP for Regulatory Affairs for American FinTech Council. I'm also a panelist today, so appreciate the participation. From here, I will hand the mic over to our fearless moderator, Cathy Brennan.
Thanks, Yana, and hello, everybody. I'm Cathy Brennan. I'm a partner with Hudson Cook. We're a national law firm that focuses solely on consumer and commercial regulatory compliance for all sorts of credit providers. And I'm delighted to be moderating this discussion today with our illustrious panel. And I will introduce everyone in turn. First up, who was just speaking, is Yana Miles. Yana is General Counsel and Senior Vice President and Head of Regulatory Affairs at the American FinTech Council. She focuses on a variety of innovation and lending issues, along with corporate governance and regulatory policy. Prior to joining the AFC, she served as Senior Counsel in the House Financial Services Committee under Chairwoman Maxine Waters. So that's awesome. Next is Mark Burnside. He's the director at FORVIS. He has worked in regulatory compliance for financial institutions for nearly 30 years as a consultant and an educator. FinTech has been his primary focus for the last few years, including assisting institutions in addressing due diligence and risk questions from supervisory agencies. Next, we have John Beccia, who's from the CEO of FS Vector, a DC-based consulting firm that delivers a range of advisory and advocacy solutions to FinTech clients and banks. He previously served as General Counsel and Chief Compliance Officer for Circle Internet Financial, Deputy General Counsel for Boston Private Financial, and Chief Regulatory Counsel for the Financial Services Roundtable. Next, we have Jonah Crane. Jonah is a partner at the Klaros Group, an advisory and investment firm focused on the future of financial services. He helps banks, fintechs, and banking-as-a-service platforms build durable and scalable partnerships that meet regulatory expectations, which, of course, we'll get into being ever-shifting and ever-changing, so it's very challenging. Jonah was previously an official at the U.S. Treasury Department and an aide to Senator Chuck Schumer. And last but certainly not least, we have Gabe Hidalgo, who's Managing Director at FTI Consulting. He has a deep regulatory and operational knowledge of banking, virtual assets, and fintech. He has worked in the area for more than 25 years, creating, implementing, and remediating and updating compliance programs to exceed regulatory requirements while advising clients on industry best practices. He's held several chief compliance officer roles for banks and fintechs and was previously a regulatory bank examiner with the Federal Reserve Bank of New York. So I think we intend this to be a very dynamic discussion. And I think the first thing we'll just talk about, just to level set, are what are some of the regulatory issues that have emerged in the last year and that you expect to see continued regulatory attention on? And Yana, I'll ask you to address that, and everyone else can address it in turn.
Sure. So, a series of regulatory issues. I mean, we've got, just looking at the title of this webinar, we've got the Federal Reserve kicking off its novel bank novel activity supervisory program, or NASP, that premiered earlier in the summer. And that's creating a lot of questions on supervision and supervisory structure. And certainly, creating questions of what is novel, what is a novel activity, and having that transparency and that framework, that building framework that the Federal Reserve is working on. That's a major piece. I'm sure my colleagues are feeling pretty heavily or very aware as well. And other pieces that that will have implications in terms of banking innovation and novel activities revolve around evolving proposals that will change the face of what we understand to be data privacy. I think many of us are waiting with bated breath for the CFPB to release its Section 1033 proposal regarding data privacy. There are certainly considerations, Graham-Leach-Bliley or GLIBA in terms of business exemptions that we've relied upon over the years. And, we're expecting, a lot of modernization and changes and additional compliance efforts there. We know that the CFPB is also kicking off understandings of changing definitions of what a data broker is, and the implications of people who are data brokers, who aren't, that would be looped into a potentially expanded definition of that. Updates to the Fair Credit Reporting Act related to the data broker issue that will certainly encapsulate a lot of institutions that work with data and deal with data well outside of the traditional credit and credit reporting bureaus. Many other issues, lots of changes upcoming, and or additional viewpoints from the regulators on AI, the use of AI, and credit decisions and lead generating decisions. I probably just be quiet now. I could talk all day about what's in store for us, but it's, as a nerd, I can say it's a very exciting time, but it's also, we're going into a new regulatory realm and a new regulatory regime, and that's gonna, there'll be some growing pains with that, and certainly some questions as to how to proceed there.
Yeah, and so who are the main regulators at play when someone's thinking about banking as a service and fintech partnerships? Who do they need to pay attention to when they're building out their programs?
So, it depends on the bank structure. Certainly, state-based banks will have one regulator, and others. But the Federal Reserve, one to watch, the FDIC, Federal Deposit Insurance Corporation, certainly the Office of the Comptroller of the Currency, or the OCC, and our friends over at the Consumer Financial Protection Bureau. I would say those are the major players to watch that are already making a lot of moves and are signaling more for the future.
And Gabe, I'm gonna ask you, who are the states that have been particularly active in the fintech space?
Sure. New York State obviously has been a leader. I think when you look at the states that step up front, it's typically going to be the bigger states that have a larger consumer population. It's going to be New York. It's going to be California. We've seen lately, I think California has a bill out there in regards to crypto. And so you see what New York State did with the BitLicense. Now California is getting into the act. I think it's a good thing. Then you have other states that are going to be diving in as well. You're going to see Florida, Texas. The states that literally have the largest populations of American consumers are typically the ones who will lead, and then other states follow. So I expect that to keep occurring. You're going to have some states like North Carolina that create novel laws. They tried to do something similar with crypto. So we'll see what happens. But in regards to fintechs, those would be the states that kind of are leading the pack.
Anyone else want to weigh in on the various state regulators that have gotten involved here? Because I know that we all know that there's some states that maybe some of us are surprised.
Oh, and I forgot Wyoming. Sorry.
Right.
I almost forgot that one.
Wyoming has reared its head for some reason.
Speedy. Yes.
Yeah.
Yeah, I mean, look, I'd +1 on all of that, and California, certainly the state to watch across the board. I think we don't sleep on Illinois, and even states like Texas are moving forward in ways that, red state, blue state don't necessarily fit into that line. So I would add that.
Yeah, I mean, a lot of the states are filling the gap here. I mean, I think if you take a step back here and look at what's happening with financial services and fintech and the technologies and the activities, Yana had a good list in terms of some of the emphasis of the regulators, both at the federal and the state level. I think we're starting to see the blueprint of where regulators are focusing, both from a proposed regulation standpoint and an enforcement standpoint. Interestingly, the CFPB is bulking up their enforcement attorneys again. So we know which direction that's going. If you look at pockets like other types of activities like crypto and blockchain-based businesses, SEC, CFTC has been very active there. Of course, at the state level, New York has been active, and California, as mentioned, which is passed a BitLicense type of a regulation. And there's other activities that are clearly in the crosshairs. Earned wage access, which of course I know the AFC is very active on. There's been some legislation and some other activities both in California and Nevada there. other types of activities, that we're looking at in terms of buy now, pay later, in terms of other things. And so the states very much have a role here. They are filling the gaps where the federal agencies aren't at play. We see a lot of these fintechs, if they're not in a partnership, they're obviously regulated at the state level as money transmitters or through a lending type of license and whatnot. And of course, we have the state attorneys general who are very active too and looking at, the consumer protection issues very closely. So it's a very, very active regime from a regulatory perspective, and all these regulators have their own mission, but at the end of the day, it does come down to mostly, safety and soundness and consumer protection, and what are the risks and what activities are most need the most scrutiny from that standpoint.
So with this intimidating number of potential regulators, both at the federal level and the state level, Mark, when you're advising banks on developing their compliance programs, where do they look for the rules of the road and the things that they need to be concerned about?
Well, so that's something that I talk about a lot. So if we have a bank that's an FDIC regulated institution, a lot of times they tend to try to focus on what the FDIC information, but one of the things I emphasize is that don't limit that. Look to guidance from any of the agencies that has been put out there. We talked about those agencies, FDIC and OCC, but I'd also throw in the NCUA. They just came out September 21st, approving a final rule on financial innovation. So they're trying to deal with these types of fintech concerns in their own kind of way as well. State is always something that I talk about because, again, geography can dictate whether you have more stringent requirements you need to adhere to and things like that. And there is some general guidance out there. There's the third-party vendor management pieces out there as well, but also look further in the past. We're not just talking about something that came out last week or something like that. There was a pretty good guidance piece that was an interagency piece that was put out in 2021 that actually I got to put, so conducting due diligence on financial technology companies, a guide for community banks. And that actually is a good walkthrough of some of the basic approaches to the due diligence piece. And that's where I'm seeing a lot of pushback right now from the regulators is smaller institutions getting into, wanting to get into the fintech relationships to expand their business line. They're getting into markets that aren't walking through their front door anymore. And that's really what they want. So a lot of that discussion now, where I used to be talking to larger institutions more frequently, now it's the smaller institutions that are calling me before they even enter the relationship, saying, okay, what do we need to do on the front end? What do we need to have in place? And usually there's a due diligence committee that's established at the institution, even with the smaller institutions, that specifically is focusing on conducting those due diligence pieces on the front end before they get into those relationships in the first place. With that being said, we just had an instance that came up a couple of weeks ago where a regulatory agency was questioning the scope of the due diligence by a smaller institution that's just getting into that fintech space. So two of the things, and I might get a little bit left here, but two of the things I always mention on the front end is look at your contracts. You need to understand who has what responsibilities in that relationship. When you have that contract with that fintech company, does their responsibility, where does it begin and where does it end or transfer over to the institution? So you need to understand that risk there. And then also some functional things, making sure that your contracts provide you the ability to test the fintech process, right? That you can, if you want to pass along the costs for conducting audits for the work that's being done and things like that, making sure your contracts have everything in them that you need to have in them or that you want to have in them.
What do you think, Jonah?
Yeah, no, a lot of good points to double down on from Mark. I think looking beyond the top level guidance, right? I think a lot of people were looking to the third party guidance as, this is going to answer all my questions about how to deal with my fintech partners. And it answered like precisely zero of them because it was general third-party risk management guidance, which is fine. I think is fully appropriate, but it means you have to look beyond that. And, you know, I think there are other materials out there that the regulators have put out over the years that are useful. The 2021 guidance on diligence was helpful. But at some level, you just have to understand what regulators' expectations are, and you know, you can really get a feel for that, you know, ultimately through the exam process, for better or worse. And you know, I think what we've seen is that regulators are expecting firms, even if they're relatively small financial institutions, and I think you might have been getting at this, Mark. Even if you're relatively small, if you're supporting fintech partnerships, the regulators view that as complex, and now we know novel. This term is taking on a lot of meaning, and they're going to basically treat you like you're the next rung up from a size perspective, and that means much more intensive and frequent exams. That means just a higher level of expectation, and oftentimes the banks, you know, if you're $1 billion or $2 billion bank, you don't really know what it means to be regulated like a 10 or 12 or $15 billion bank, and so you really have to, you know, think about, you know, that enhanced level of expectation and go the next level. And I think, Mark, you offered some good tips. You know, the contract is really important. Regulators really do look to that. Ultimately, the bank is accountable at the end of the day for everything that goes on in these relationships, because these are bank customers and these are banking activities operating under the bank's legal authority. But the bank can assign responsibilities to the fintech partner. It's just that they better be real clear who's doing what, and you know, ultimately who's responsible, and you know, how does the bank protect themselves in the event that somebody falls down on the job. And that's where we see a lot of problems arise, is just lack of clarity around roles and responsibilities. And so really just understanding that, you know, these kinds of partnerships require a level of attention to detail that you know, maybe folks just aren't used to operating at that level.
And do you mind if I just throw in also the exam procedures? You know, you mentioned expectations. So one of the things that I emphasize a lot is, you know, there's a difference between the regulatory requirements laid out versus the exam procedures. The exam procedures a lot of times will include the questions that the examiner is going to be asking the institution, and will give you an idea of what their expectations are, in addition to, you know, what other institutions have gotten in trouble about already.
Yeah, we don't have tailored guidance yet around quote novel activities or fintech partnerships, but it's actually something I wouldn't be surprised if we see in the near future as the Fed builds out their novel activities program and the OCC does theirs. So that'll be an important landmark. Until then, you're right, we are, you know, having to sort of read between the tea leaves and look at enforcement actions and try and divine the expectations from these various sources.
Yeah, I think that transparency of the process, I mean, it makes sense that, you know, regulators are looking to monitor, you know, what they're calling novel activities, emerging markets. We are in a place where we have markets that exist radically differently, or you know, than even 5 years ago, or some that barely existed at all 5 years ago. And you know, as regulators like the Federal Reserve, OCC, and others, as they refine that process, it will be very critical, because even if there's a question of how novel is defined, as there should be, we're still in a position where a one size fits all approach on examinations isn't going to work. It's certainly not for the novel experience. And I think from what AFC and our members are hearing, at least from the regulators, I think that there's an understanding to avoid a cookie cutter approach. But it's something that, you know, we'll continue to stress, you know, because our companies, you know, they don't want to find out at an enforcement action that there was something that they dotted improperly or missed, especially in the realm of, you know, an emerging supervisory program like NASP, for example. Not to pick on NASP, though.
I think from a compliance standpoint, I mean, we do have some guidance here, but you know, there's never going to be prescriptive guidance, and I think it's incumbent to look upon, you know, what we know in terms of, you know, we've seen now with some of these enforcement actions, with Blue Ridge, with Cross River Bank, we see with the FDIC's guidance on corporate governance that, you know, board needs to have more authority and oversight. And we know as a bank, some of us come from a bank compliance background, we know the kind of bank regulations and regulatory perimeter and areas that we need to cover, which is BSA, AML, and consumer protection and information security and privacy and whatnot. The question is, where we see clients get into trouble is where they do things halfway, or they don't put the right amount of resources. And again, like has been said, with the roles and responsibilities and the operational workflow is critical. I think unlike traditional bank compliance, we have the 3 lines of defense. Here, you have to make a decision in terms of how you're going to structure this partnership. Is the bank, ultimately, we know the bank is responsible, it's on the hook, they're the regulated entity, but are they going to maintain more level of oversight? Are they going to work with a middleware provider to prop up a program, or are they going to outsource a lot of the obligations to the fintech? And whatever path you choose creates both costs, risks, and complexity. And I think the other area to really at the outset is really understanding where those risks are, the types of partnerships you have, and also understanding if you have a lot of partners, in terms of what that portfolio looks like, in terms of how that's going to impact your overall organization. And so that risk assessment is critical, as well as, the operational workflow, understanding the audit and testing of the program, and having that be on an ongoing basis, the record keeping, the ability to provide the data that is needed either for the bank partner or for the regulator, and all those types of things. And then really having kind of an ongoing kind of change management program, understanding that the shifting winds out there, not only through your own examination process, but the external factors. And then really understanding, how you're going to really having a tone at the top, and having strong senior management and board oversight over these programs is critical, because there is so much pressure right now from a supervisory perspective. And then if you do have issues, being able to respond to that in a very quick and efficient manner is critical.
I think John makes a lot of good points. I think another issue that we've seen in regards to these banking and fintech partnerships is, the banks are well aware of what the responsibilities are, but I think that sometimes the fintech clients of these banks view themselves, for example, as MSBs. And as MSBs, when you look at the MSB guidance that's within, like, for example, the examiner manual hasn't been updated in years and hasn't really been tailored to what fintechs do. Or their products or services more tailored to, for example, MTLs, or money transmitters. That type of guidance is what they're relying on. And so they go for like the bare minimum at times. And then the bank comes in and says, hey, we want you guys to do this level of reviews and everything else in order to stay within our contractual bounds. And at times the fintechs say, well, no, as an MTL licensee, we're only required to do X. And so that difference between what the bank needs to be done and what fintechs want to do, that gap is really what can create problems. And so we've been advising clients of ours who do partner with banks that they need to be aware of what the banking requirements are, and to look at the banking guidance, the examiner guidance, to see what the banks are going through, and to try to get to that level, because ultimately that's going to help their relationship with banks overall. And let's be honest, every fintech is going to have more than one banking partner. You need a backup in case something happens. And when you raise the level of what you're doing from a compliance perspective, it only helps you in trying to accumulate those banking relationships. So you're not relying on only one. And if you lose that, you lose your business. So I do think that there's a gap to overcome there. And I do think that the fintechs have been learning that over time. But I think there's another angle here. I know that we're talking about the AFC, that's great, but there are foreign fintechs that come to the United States looking to establish banking relationships so they can actually operate within the US. Those foreign fintechs don't really have a good understanding a lot of times of what's required within the US. And so they need a lot of handholding. And this is, I think, where banks can step in and help them establish an appropriate compliance platform, and kind of help guide them into what's required at the outset, at the very beginning, so that they don't find out, a year or two later when the examination's taken place that, hey, you guys haven't really been doing what you're supposed to do. And it takes more than just contractual statements. It takes actual handholding, I think, a lot of times from the banking partners to make sure that they can get those foreign fintechs up to speed on what's required.
Yeah, so we're at least a decade into these bank partnerships. And in some ways it's remarkable that we don't have more clear, definitive rules of the road. But in other ways, there's benefit to not having those clear type rules of the road. So Mark, how important is it to bank partnerships that regulators develop clear rules of the road that we would then all strive to help our clients reach?
That's a good question. So, any additional information I think is beneficial. The thing that I always think about is that no matter how specific requirements are or regulations are or guidance is, they're not going to be able to think about everything. So no matter how hard they try to pinpoint as much from a process standpoint as they can, it's never, I don't see that really ever happening. I mean, every fintech relationship is so different. You know, the fintech models can be, you know, deposit, it can be lending, it can be onboarding processes, it can be underwriting processes, and all those have totally different risks related to those. So from a supervisory guidance standpoint, it's still going to be structurally driven. It's going to be risk driven and things like that. There's not, I really don't see anything that's really going to target very specific types of fintech companies that get into those, you know, like that, again, going back to the due diligence, you know, kind of overall due diligence discussions, third-party vendor management, things like that. I mean, I see that now from the regulator standpoint. I can see them developing technology teams that focus on certain types of fintech companies. You know, I could certainly see that as being a possibility. And I think it's very good that they're looking to that, you know, that they're looking to develop teams that work specifically in those spaces. So one of the things that I talk about a lot too is that, you know, we have to remember that as we're going through these growth pains and as we're dealing with these new products and service and risks and things like that, the examiners are as well. You know, they're learning as we're learning. So you know, that's something we need to be aware of. We need to be able to work through as well. And it's going to develop, but it's going to develop as they start seeing where the problems potentially lie. You know, if they go into bank and they have a fair lending issue that they've identified, they're going to look for that same issue at every other institution that has similar types of relationships and things like that. So it'll develop and it'll get better. But again, I that's a tough one to say. That I think there should be a lot of very specific targeted requirements versus not. Because if there's not, then, you know, we have to try to figure out what the expectations and things like that are. But then if there is, then it can feel like a throttle or like a control or a, you know, on our ability to innovate. And it's interesting too, because, you know, they keep coming out and saying, you know, we're excited about this space. You know, we want innovation in this space. We want consumers to have more opportunities to have financial products and things like that. But then we're figuring out the back end of it, right, as far as controls and things like that go. So anyway, I can't say that I think they should be a lot more specific about it. I mean, I think they should be a lot better than they are now. As far as guidance and expectations and things like that, certainly. So,
yeah, sorry, go ahead.
Oh, thank you, Jonah. I look at federal rules. You know, I look at them in a way that they should serve as a floor and not a ceiling. So, you know, in terms of you know, feeling constrained and the, you know, kind of unintentional ways that innovation can be stifled, you know, like responsible innovation that's actually going to be good for the market, good for institutions and consumers, ends up getting wrapped up in things that are too prescriptive or are too specific rather. And so, you know, I think that a federal floor, you know, really it creates kind of a baseline of behavior. Many of AFC's member companies and you know, my fellow panelist companies operate across the country. And when we have one regulatory framework in California, another in Wyoming, another in Illinois, another in New York, you know, we do come up with a different type of compliance, I would say, a conundrum or a different type of structure. You know, you know, kind of like a patchwork framework of different sets of rules that could be radically different from state A to state B. And so I do think that you know, it would be great to see some discussion of a new true lender rule. We know that in terms of, you know, bank fintech partnerships, we know that the OCC's true lender rule was invalidated by the previous Congress. And there's certainly legal conversations as to what substantially similar means in terms of what happens when a rule is invalidated. They can't do a rule that is considered substantially similar. That's never really been defined. So we are in this place of this congressional tool that was barely used, that got used a lot in the past 5 years, That's resulted in some questions as to how to move forward at the federal level. But it would be good to see some type of baseline that multi-state operators can work off of.
Yeah, I mean, I think, well, there are many areas where a little bit more clarity, or at least a better sense of what regulators are worried about and focused on an area would be helpful. I think I share the general sense that, you don't want to get too prescriptive, and it's easy to slip and slide in that direction, right? I think the industry tends to call for more and more clarity on just about everything, but it can become a bit of a trap. And I think not just in terms of hamstringing bank boards or managements, but in terms of actually undermining the ultimate objective. I think one of the bigger challenges we see, or one of the biggest, I'll say, shortcomings in risk management that we see is a sort of check the box approach where, filling in the fields in a risk assessment template is not the same as doing a risk assessment. You really got to understand the risk of the business that you're engaged with, and really address that risk. And there's an awful lot of judgment at the end of the day. And so I worry a little bit about moving towards an approach where things end up in more sort of check the box form. We're obviously far from there. And one of my glass half full views of the novel supervision programs is that, just having some uniformity in how they think about these issues, and the kinds of questions that get asked in an exam. And so the local examiners can say, yeah, this is what we expect, and we think what you're doing meets our standard, rather than having to turn around, which we're seeing a lot right now, and ask Washington, hey, is this okay? And then everybody's sort of left in purgatory for a while. And so I think I'm hopeful that, the regulators have been through a bit of a learning phase on bank fintech partnerships, have their arms a little better around it now, and that we're going to at least unlock some of this, sort of hesitation that examiners have had to give the nod to banks who are really trying to do their best to manage the risks here.
Yeah, I agree. I mean, I think, with everybody, in terms of prescriptive is not the way to go. We do need clarity, but I think it's a principles-based approach. And although, we've seen examples of how that has worked and not worked. I mean, the one example I point to is the BIT license, which, the principles matter and the definitions do matter. If you're too broad, then you can't innovate. If you're too narrow, then there are gaps. And also the big issue of the technology is always moving faster than the regulators. And so, you can't possibly capture everything under a regulation. So where does that leave us? That leaves us to going back to the risk-based approach, both from a regulatory perspective and industry perspective. And so as an industry, it's looking at really focusing on those risk assessments and helping educate the regulators, frankly, these offices of innovation and these other groups, coming to the table with real data, real understanding of, here are the benefits, here are the risks of these products and services, and here are the areas where we may or may not need a regulatory framework, I think are very important. So I think, at the end of the day, it's important to, get those principles right and have some kind of basic framework that you can work upon, but it's never going to be perfect. And, there's never going to be a process, even if you look at like no action letters or things like that, those are just the four corners of the document. And anytime you go beyond that, or anytime the technology evolves or products evolve, you can't possibly capture everything. So it's a fluid process, which means, ongoing collaboration, ongoing diligence, again, both from the industry perspective and the regulator perspective.
So Gabe, when you're advising clients to build out their compliance programs, compliance from the fintech perspective, sometimes, particularly at the start of a new venture, is seen as an afterthought or a cost center. And oftentimes, less frequently now, but many times over the years, I've been surprised to learn that some fintechs think they don't have any requirements because they partner with the bank. So I'm sure you've had that same conversation, and curious to see who is responsible for compliance and how that might change over time as the relationship evolves.
So, I mean, there's nothing that is out there that would say that the bank loses any responsibility for compliance. Ultimately, everything's moving through their payment streams, through their platform and everything. The issue really is on the maturity of the underlying fintech. There are some fintechs out there that have great ideas. their founders have put together beautiful pitch decks. They've received investments. They've built out their teams. But what you'll see typically in those pitch decks is the section on compliance is threadbare. And the reason for that is, for many founders, and I apologize to any founders who are compliance experts, but the majority are not. And therefore, what they're doing is they're looking to create efficiencies in the way that things are done as a product or service for the fintech. Now, focusing on user experience or UX as is known within fintech parlance, those are areas that they're experts in. But the compliance part of it doesn't become an issue until they're ready to start moving forward and they start to look at some of the issues that they see in rolling their products and services out based on the US requirements. Now, when you get to the level of the bank and they come together, fintechs really, I used to see this. I was a chief compliance officer at a bank and we had a new customer acceptance committee, and I was part of that committee. When they would give me their policies and procedures and they would give me their platforms for compliance, you could tell a lot of times that the newer fintechs had these very templated policies, very templated procedures. They had not actually conducted these procedures because they are not in business yet, but they needed a banking partner in the US to get up and running here. And so what you have is this immature program that thinks that they know what they need, but once we reviewed it at the banking side, we knew kind of what they needed. And so we would need to almost teach them from an operability, from an operation standpoint, this is what you need in order to get this going. But before we can approve for you to be on our platform, you're going to need to have all this in place. For a lot of them, that would come in shock. Now, some banks could operationalize their already mature compliance programs and be an extension of the fintech and absorb those things that they would normally put on the fintech to do. We've seen this with transaction monitoring. We've seen this with sanction screening. We've seen this with a bunch of different things. But that only happens because the bank is prepared to absorb those responsibilities, to absorb all those additional things that they would normally put on fintech clients. So in short, the responsibility always falls with the bank. But the bank can, by contract, say, listen, we'll take care of this. We want the fintech to take care of that. But it's really going to depend on how mature that fintech is. If you're a fintech that's already been in business 2, 3, 4, 5 years, already has maybe a banking partner, then you know what needs to be done. You've already been through the hoops of reviews. You probably have a few audits under your belt. But if you're a brand new fintech, a lot of them do not understand the compliance requirements. And they may only understand it because legal counsel told them this is what you need to be aware of. But they have not actually carried out what needs to be implemented. And so at that point, the bank needs, if they really want this client, they're going to need to handhold with them and probably share in some of that operational burden of helping the fintech get up to speed and take some of that operational burden in the beginning and then over time shift it as the fintech expands, as they grow, as they hire hopefully competent compliance people. We've at times recommended to our clients who are looking to hire people for compliance is, take a look at what they call legacy institutions, some of the banks. They have great people there who understands the ins and outs of all the compliance that you need to operate in this space. They may not understand all of the technology, but I'm sure that you can get them up to speed on that. But partnering with someone who has that legacy understanding of the compliance rules and then being able to apply that to your novel product and service is going to be a boon for you. And you're going to be able to not only do well from your own compliance perspective, but also when you speak to banks and trying to partner with banks, they're going to understand each other much more than what currently happens.
Thanks for that. And that raises to me the question of we don't have necessarily as much specific guidance as we might want, or maybe we don't want it, but we don't have it. But we do have plenty of laws on the books, many at the state level, that were enacted at a time before we had fintech. And we have seen fintechs wrestling with whether or not these requirements apply to what they're doing, if they should apply to what they're doing. We've seen some interesting interpretations of those laws by state regulators. And we all know there's certain states that you have to do certain things if you're engaged in certain activities. So Yana, in your journey, you see a lot of these old laws that are applying in this space. How did fintechs navigate that? They're not squarely within the laws, but there's certainly some argument that the regulator might make that they have to comply.
Yes, it's a very obvious tension that we see, and I would say, with AFC companies, somebody brought up earned wage access, for instance, and for instance, we're in a place there where there are states that are deciding whether or not that's a credit product. Like we can tell you all the reasons why earned wage access is not a credit product, but that's not the topic of today's panel, so I won't go there. But that being an example of many where we've got new products, we've got earned wage access, we've got buy now, pay later, we've got all these variations of these things, and other variations of small dollar products, and that some of that are credit and some that we argue are not, that do not fit the definition. And states are in a place where there's this one undertaking of revamping their regulatory regime, or just fitting one piece of it to a puzzle and squeezing it into another. And I think that there are many ways in which the existing state regulatory frameworks can absolutely support evolutions in financial services products and loans. But I think there are others that really require a closer look at whether or not some definition written in 1997 applies in 2023. I mean, in my head, the 90s were like 10 seconds ago, but younger people remind me that it's not. And so, that's where that's the tension of where we're at. All the more reason, going back to my plug for, the need for a set of reasonable federal floors as to, really setting the standard. But, yeah, I mean, it's a big undertaking, because if a bunch of states decide, okay, we're gonna create a new set of rulemaking for all of these novel activities, that creates one set of questions. If they try to fit one size into all, that creates another set of problems. My recommendation to AFC companies is to lead with data. I use another kind of a common term you might see on reality TV. I say, look, bring the receipts, show the receipts. Show them the data, show them what you're working with. We don't want to run from regulators. We want to run to them. We want them to know who we are. We want them to understand our models. The more that's understood, the better likelihood we have of outcomes that are policy outcomes that are more reasonable. So that's a recommendation. It's not a popular one, but it's one that I do think is better than beating on the drums after some decision comes down that we don't like.
Yeah, that sounds like good advice to me. John, I'm gonna pick on you for a minute. So we see the federal banking regulators now adopting specialized units to think about fintech. How useful is that? And we've seen some of these offices come and go also.
Yeah, we have seen it in the past, and there's been varying levels of success or interactions. At first, when a lot of these offices of innovations were propped up early days, there was a real collaboration or a real thirst for education, and you could go into these offices and have a conversation. I think the real issue now is what's the end game here in terms of these offices? Are we going to see any kind of recommendations around regulations, or is it going to be a room where you have enforcement attorneys join every meeting and be more focused on that? And we are a little bit in that regulation by enforcement mentality these days. And so we see now the OCC has restructured a couple times. They've restructured both the fintech innovation office as well as their exam teams. We see the Fed now with the oversight over novel activities. We see obviously CFPB with not only different offices but also expanded authority over their examination of non-banks. All these things are good in terms of having some type of interaction or oversight and understanding. But now the question to me is, where is this going to lead in terms of any kind of real results or any kind of more clarity and guidance? Because that's the real challenge that a lot of the clients face, whether you're on the bank side or the fintech side, is getting really understanding and feeling though that you understand the rules of the road and can be able to move forward. So hopefully we see more forums. And I think, though, it is incumbent still again on industry to come with real data, real information for these offices to understand the risks. We keep repeating it, the mantra, but it does come down to you can't understand how to regulate things if you don't understand what the risks are at the end of the day. And so, hopefully the offices are kind of leading to that. But again, there's still questions in terms of what authority and what actually are going to come out of these offices.
And I'll just dive in, again, be a little defensive of our regulator friends. And, if we go back to the lead up to the 2008 economic collapse, one of the things that I recall, coming up a lot, and I think it's understandable, was a question of where were the regulators? Where was everybody when this was leading up? Where was everybody when the subprime loans and Alt-A? Where was everybody when these were proliferating? And who was at the wheel when these were getting peddled to people that had a harder time affording it, or were just straight up unaffordable in the first place? And and a whole new agency that is a very consequential one resulted in some of these questions as to they would call it a cop on the beat, somebody paying attention to what was happening in the markets. And so a lot of the existing regulators took a lot of hits in that discussion. And for them to be in a place where they want to understand new activities in emerging markets, I mean, I do think that that's a good thing. Obviously what brings pause is what comes out of it, what we know of the process, who we know the engaged stakeholders are or are not. So certainly there's concerns there, but it makes sense that there is a push to understand changes in the market and changes in financial services products.
So you bring to mind the truth of the early 2000s, which was real estate prices will always go up. And that was just a given. And so there was a lot of creative activity, some might say novel type of mortgage products based on that fundamental truth. So I'm curious, Jonah, I'm going to throw this to you. Are there any things that you sometimes wake up in the middle of the night and say, I know everyone thinks this is true, but what if it's not true? Like, are there any assumptions that people have that are in the fintech space that maybe they shouldn't be so comfortable having?
Well, I think there are two very different assumptions that people in the fintech space have, both of which get them in trouble. One is that the regulators don't know anything, and the other is that the regulators know everything. And I think both assumptions can be very problematic. I think you, at some level, have to assume some version of both, right? You have to really explain your business. I think, Yana, you hit the nail on the head. The more regulators understand your business, the more likely they are to try to work constructively there. I think to John's point, the sort of glass half full version of the novel activities type programs is they're going to bring, expertise, really creating something like centers of excellence to help disseminate the knowledge that they're building by learning from the industry out into, onto the ground. And hopefully it bears fruit in the supervision process, just in terms of a smarter, more sophisticated approach there. So that, again, glass half full. I think one of the assumptions on the regulatory side that seems to have really accelerated over the last several years. I mean, I think the early days of these offices of innovation displayed, as John said, a real optimism around the possibilities here. And I think regulators have, over time, and this has been a process here, but they really, I think, come to view innovation generally with a pretty skeptical lens. And there's certainly no sense of innovation is good for innovation's sake. That was gone long ago. I think now there's almost an inherent skepticism that innovation is going to be problematic. And I think while a lot of the regulators seem unhappy with the status quo, whether it's from an innovation or access or competition perspective, if you're the Bureau, it's not clear to me what appetite they have to do anything about it. I personally am just really disappointed in the direction we've gone in terms of things like sandboxes or no action letter processes, and just providing some way to experiment. Because to tie the last few points together, Yana, you talked about how we have these square peg round hole problems with new technologies and old laws, and John, you talked about innovation offices used to be slightly more adventurous and open setting, and I think we've gone a little bit in the wrong direction in the last few years on that. So I'll get off my soapbox now, but I think I think opening up some more space for experimentation there could help to solve some of these issues.
Yeah, so along those lines of things that regulators might be interested in pushing or have concerns about, Mark, what are you seeing the banking regulators, both at the state and federal level? Does the state banking regulators also get involved here? What are the products or the types of activities that you see them focusing on?
I will say is that the majority of my clients in fintech relationships are product or service driven, right? It's about deposit accounts, it's about commercial lending, consumer lending, and things like that. So again, there's a real focus right now on the front side aspect of it, so the due diligence before getting into those relationships, and kind of pointing to what was mentioned earlier is that what I always say to an institution is you need to document things in a way so the third party can review that information and come to the same conclusion that you came to. So from a due diligence standpoint, if we're making business decisions, we need to be documenting how we're coming to those conclusions, and it needs to be clear enough that an examiner can come in and look at that documentation or that process and procedure and understand it and come to the same point that we came to, the comfort level that we came to as well. The other thing I want, and I know this might be a little to the left as well, is that a question I get a lot is, in a general way, is which agency is the hardest? Is it the OCC, the FDIC, the NCUA? And my response is always, it's the person who's walking through your front door. So regardless of the agency, so many times when I end up working with an institution under a regulatory agreement, that it was that person that was walking through their front door that just had a different approach, or just harped on one thing maybe harder than another examiner might. So those are things that institutions need to be prepared for. On the backside, you've got certain regulations that are going to apply to so many high risk pieces like BSA that was mentioned. CIP is a big aspect when we're talking about a fintech company that is providing new products and services and things like that. We also, when we talk about the variation of fintech companies, we also need to be aware that when we talk about fintech companies, we're not just talking about onboarding new products. We can be talking about a new platform one of the Latin conferences I went to, some of the top new fintech companies were about how do we create alternative credit histories, right? That's a big thing right now. And so, we need to be looking at what's our comfort level with their approach to creating alternate credit rating processes and things like that. And how's an examiner going to be looking at that when they walk through the front door? So sorry, getting back to your question, I think I've seen a lot of due diligence pieces right now, a lot of focus on the due diligence side before they get into those relationships, especially because there's so many smaller institutions that I've been talking to that are looking to get into that space and may not have the level of expertise on the front end for that. On the back end of it, again, it's that testing, it's the monitoring, in the context of that relationship. So a lot of the institutions we're working with, they're monitoring quarterly. They're not testing annually, they're testing the different regulatory aspects on a quarterly basis. And that can be beneficial because if your examiner gets comfortable with your process, then going forward, it's not uncommon that they'll come in, they'll look at there's either internal audits or they'll look at the independent audits, and they'll say, okay, that covers, if they're good with it, the first couple times, then they're going to be comfortable with it as things move forward. A lot of that focus from an examiner standpoint is going to be on the front end side of things. Once you've got your process developed and your examiner is comfortable with it, it tends to go a lot smoother going forward there.
One quick point on exams, well, actually three quick things, because what we're seeing is different than we've seen in the past in terms of oversight over compliance. One is the level of requirements of board oversight these are crazy times to be on a board of a bank, just because of the expectations now, which are just increasing over time. Two, the use of systems, how you use them, how, if you're relying on them, how they're integrated and how they're tested. And three, the scope of transaction monitoring, especially in terms of looking beyond to your customer's customer. We're seeing a lot of broadening of the requirements in those areas.
Thanks, John. And I'm gonna kick this to Gabe, because we've seen over the last year or two a few of the banks that had been in this space exiting this space. What do you take from that fact, and what do you think the future holds here for these types of partnerships?
I think from the exiting, I think some of these institutions probably underestimated the amount of resources and the amount of effort that was needed in order to onboard some medium and higher risk fintechs, where I think the profit numbers up front looked great. The reality from a compliance perspective was it ended up being too costly, and those the compliance requirements probably were not projected correctly. I do think, though, that from a future perspective, there's going to be banks that will leverage their mature compliance departments and convert that compliance department maturity from a cost center to a profit area by charging these medium and higher risk fintechs even more in fees in order to make sure that they have the appropriate compliance coverage, and doing that in-house, because obviously you have a mature compliance program and you can extend that to cover some of these more riskier fintech clients. I think by doing that, not only do you allow the fintechs to grow, but you also create a better profit center out of what's typically and historically has been known as a cost center. And I've seen several banks do that successfully. But it really takes the appropriate compliance leadership. You have to understand exactly the types of fintechs and products and services that you're willing to get into versus those that you're not willing to get into. And you have to have board of directors buy-in, because they need to understand exactly what you're going to be doing over the first 2 years and then beyond that, in order to get that to match the expectations of profit from this business line to the reality of what it may look like if certain things don't fall into place. But from our client perspective, we have seen some of our banking clients succeed in this and do well, excel in this. But again, they have those mature compliance departments that they can then extend. They can do creative hiring and then be able to charge those fees to the fintechs to cover the hiring, the training, and then the retention of those compliance folks. But again, it takes a lot of planning. You have to know exactly what you want to do. You have to understand the types of clients you want versus the ones that you don't want. And then obviously, there's a very active pool of constant fintech customers that are looking for banking relationships. And I think that you marry that with what I just described from a banking perspective, and you could have a very successful banking as a service product. But I think, again, it takes appropriate planning, and you have to understand what you're getting yourself into. This is where I say, like, mature compliance leadership that has both knowledge of technology, compliance requirements, and banking comes into play. That mix, there's a few of us out there, but it's very important to get. And if you can find the right one, and you put them in a senior leadership compliance position within your bank, they can help drive this, and they can make your bank successful at the banking as a service product.
Thanks, Gabe. And it doesn't look like we have any questions in the Q&A, so I'm going to throw out just a general prediction. So what do we predict over the next few years for these partnerships between banks and fintechs?
I think that they will continue to thrive. I mean, we've discussed a lot of the benefits today. And I think especially Gabe just now, and I think that this is something that's going to continue to be beneficial. We're in a space where especially smaller banks, they're facing consolidation. And we're losing, unfortunately, we've had this steady decline since the 80s of the presence of small and community banks. And there's a huge benefit there to institutions like that work with a lot of diverse customers, and economically and racially diverse customers and communities that have that capacity to work with lower and moderate income communities that are boosted by the capabilities of a fintech at the structural level, at the technological structural level and otherwise, and certainly risk sharing, as Gabe outlined and others outlined on this call. And so I think that will continue to be very important. And I think that will continue to put a lot of pressure on federal and state regulators to either enact or refine current law as it addresses how these partnerships are managed, especially in an outlook where certain pieces, like for instance instant rate caps, the maximum allowable interest rate cap, that varies state by state. Ensuring that a regime can exist in this way with this diversity, it will be extremely important going forward.
Anyone else want to weigh in with a prediction?
Sure, I'll step in on this one. I think from a fintech perspective, I think investing products, fintechs that offer a lot of easy pathways for consumers to invest in, whether it's traditional assets or some of the novel assets. I mean, we've seen this where, like a company like Fundrise with their real estate products, or, a company like Robinhood that allowed a lot of people to invest easily. Those will continue to grow because customers demand access. And you've seen the success built off of that. When you give customers easier access to things that typically were not easy to access, that's where you have explosive growth. I think some of the banks will end up purchasing or acquiring some of the lending platforms that create efficiencies within the marketplace because they're realizing that the way that they do lending is probably inefficient. And when you have these lending platforms that can turn around decisions pretty quickly, that can, provide algorithms that take care of all the underlying, consumer regulatory concerns and do it in a way that's efficient and doing it in a way that's compliant, that's going to be very attractive to a lot of banks. They may acquire those, they'll put that in their own platforms, and they'll become more efficient that way. So you'll have, I think, consolidation on the lending side. I think investment-wise, you'll have a lot more growth in that area, simply because customers want access. Social Security for retirement is no longer a dream. You can't do it anymore. And so the ability to be able to invest in not only traditional assets, but alternative assets becomes a bigger concern for the future. And I think some of these fintechs that do offer those platforms and do it in a way that's safe and compliant, I think it'll only grow.
Look, I don't think this model's going anywhere. In order to offer banking products and services in this country, you need to, have a banking license or work with a bank partner or go get your own licenses. And so there are only so many paths to market. I think, in the short term, though, banks are going to have to be much more hands-on in these programs than many of them have been over the last several years. That's going to raise the costs, as Gabe laid out, and that's going to reduce the velocity with which fintechs come to market for a little while. And, it happens to coincide maybe with a bit of a down market in tech markets and fintech markets generally. But, I think the question on the back end is, what's the sort of scalable model that we can, align on that will, allow us to have an appropriate pace of innovation entering the banking system through partnerships or otherwise. And I'm a little bit worried about where we're headed in that front. It's just a question mark in my mind. I think, at some level, banks who were sponsoring lots of fintech programs in the last several years were running something of a venture capital model. It was like, I'm going to support 15, 20 programs. Maybe one of them will be big and be the next Marqeta, and that will be great. But the rest aren't. And I'm not sure that model is going to work going forward. So I think, in a few years, let's see what the landscape looks like. That's the question in my mind for the next couple of years.
Well, and to your point, one of the things that we're seeing now are fair lending issues coming up, right? And again, on the front end, but now that we have more data, now that we have more information, then you're going to see those kind of risks in the long term that might be coming up more frequently and things like that. The banks really need to be aware of and pay attention to, whether it's UDAP, whether it's fair lending.
John, you want to weigh in with a prediction?
I think everyone said it well. I think, very bullish in terms of, there's a lot of questions, still a lot of pressures, both from a regulatory perspective and also, the fintech industry in terms of the financing, in terms of, growth and scalability, as Jonah mentioned. But I think, we'll get there. And I think the lines are going to continue to be blurred. We'll see more M&A activity, but ultimately we're going to see and need growth in this space.
Awesome. Well, I think that's the end of our time. So thank you to everybody for joining, and have a good evening.
Thank you.